from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Bitcoin soars and Coinbase it slumps. The biggest U.S. cryptocurrency exchange reported third-quarter results that missed Wall Street estimates. We'll explore why monthly transactions users are declining. Plus, Robinhood's data breach nightmare. The trading brokerage says 5 million email addresses were compromised in the attack. Can the company truly live up to its safety-first mantra its executives often tout? And the future of healthcare post-pandemic. My conversation with the CEO of Color on making healthcare easier, and the Series E funding the company just got to make that a reality. We'll get to all of it in good time. At first, let's get a look at the markets. U.S. stocks, they actually halted their longest winning streak since at least 2017 in terms of the S&P 500, sending major indices a little bit lower off their all-time highs. Could we get to, you can break it down for us?
Well, Caroline, after an 8-day winning streak, stocks taking a little bit of a breather, ending in the red. You have the S&P 500 down 0.4%, and big tech not coming to its rescue at all. You can see the New York FANG index and even the SOX index ending flat on the day. That was the outperformer for most of the session. What stayed in the green all session long? Cryptocurrencies up 3.6%. I want to dive closely into the semiconductors, into the chip makers. Check out this terminal chart. We know that EVs have been very, very hot lately. We know they've been surging, but take a look at what else has been. Those chip makers, a little known fact, an EV engine takes more chips than a regular engine does. And the stock market seems to really know that, trading in lockstep, not just for the past couple months, but really since November 9th, since that big Pfizer announcement about the vaccine. So you can see that that's a trade, very, very predictable, something to watch if and when that relationship diverges. Let's just get to those earnings stories, though, because that seems to be the hot topic after the bell. Palantir down 0.3% after hours, much more intraday after falling the most on since February, on shrinking margin forecast. Then you have DoorDash, of course, higher on the day, 7.8% after hours. This coming after they announced a all-stock deal with Finnish food delivery company Wolt Enterprise for 7 billion euros. That's $8.1 billion. And then, of course, we have Coinbase missing their estimates, tying that to lower volatility in the third quarter, saying that a lot of that retail volume that was driving the crypto space, well, they slowed down a little bit. Those shares down 10% after hours. We can get more into that topic, more into the crypto space with our very own Ed Ludlow.
Yeah, I want to look at some of the specific numbers because there are some key words throughout the shareholder letter that really give it away. So let's bring them up. Yes, there was a miss on the top and bottom line, but if you look at that trading volume overall, it's much softer compared to the prior quarter, around 320 billion or so in the third quarter, down from $460 billion in the second quarter. Here's what's so astonishing. You read the shareholder letter, Critty, and the word volatility appears 17 times. Either in reference to greater volatility or lower volatility. But the big takeaway is that trading volumes were down quarter on quarter, and clearly the market not liking it, down almost 11% in after hours. Let's get into the meat of this with Brett Harrison, FTX US president, a fellow US regulated crypto exchange. A lot to unpack here, Brett. What's your take on these Coinbase numbers?
Yeah, definitely a lot to unpack here in the shareholder letter. You know, Coinbase as a business really developed as a retail-focused business. You know, they have now 70 million users. They have around 7 million monthly active users. And as we know, retail really loves to trade crypto right now when it's moving a lot, especially when it's moving up a lot. So, for example, we've seen crypto volumes really pick up on exchanges across the U.S. In the last several weeks as cryptos have reached all-time high. But earlier on in the mid of the quarter, we were seeing, in general, lower trading volumes, lower volatility, and that seems to have a huge effect on the amount that retail wants to actually transact. And so we're seeing a lot of mentions in the Coinbase letter about how much their business is really correlated with the volatility of the crypto market.
So Coinbase is talking in the shareholder letter about how the company is a long-term investment, doesn't want investors to pay attention quarter to quarter. But one of the things that analysts really cottoned onto in the quarter was how use of the app spiked after listing of Shiba Inu coin, of course. They want to move into NFTs, non-fungible tokens as well. What is the future for the platform overall?
Yeah, one thing that really stuck out to me in the letter was the fact that Bitcoin trading on the exchange, and in general, Bitcoin dominance in the crypto market cap as a whole, keeps going down. And the amount of users that are using more advanced features of exchanges on ours, on Coinbase, are going up. So you see people trading alternative coins, Ethereum, Solana, these different coins. Certainly on our exchange, Ethereum and Solana have been steadily growing in volume. And people are using things like their earn product, their staking product, and now they're getting into NFTs. And so they are, just like FTX, getting into the NFT space. They're looking to make longer-term investments in the Web3 ecosystem and provide more of a diverse experience than just simple buying and selling of Bitcoin.
Well, on that point, come and me into my Bloomberg terminal really quick and look at this chart. Bitcoin had an astonishing rebound since July, but it's lagged the Bloomberg Galaxy Crypto Index, which of course includes other coins, including Ether. I'll hold you to a yes or no answer. Is this a maturing cryptocurrency market, or is this still nascent to the mind of retail investors, institutional investors?
I think it's still nascent. A lot of the largest institutions in the US especially have yet to be able to tap the full potential of crypto because of various compliance issues, regulatory issues that are preventing a lot of these major institutions from getting into cryptocurrencies. We're just starting to tiptoe into institutional adoption by the first Bitcoin futures ETF being released, but that's just the beginning. And until we see more better regulatory clarity that allows for these different institutions to get into cryptocurrencies like Bitcoin, like Ethereum, only then are we going to really start to see more of a maturing off of this market.
For full disclosure, my husband works over as a senior manager at Coinbase, so I won't delve too much into the intricacies of that business, Brett, but I will ask you about that regulatory question. And of course, I'm sure you're talking to regulators yourself. How swiftly are we going to see, well, a less nascent regulatory framework here in the United States?
Yeah, it's a great question. Talking to regulators and thinking about the regulatory landscape right now is a major part of what we are doing at FTX, because we truly believe that the long-term viability of this industry rests on the ability for exchanges like ours, licensed gatekeepers in this ecosystem, to be able to interact cooperatively and collaboratively with regulators, the SEC, the CFTC, with lawmakers. And it's very clear that this is top of mind for these agencies, that we want to get to a place where there's a good federal regime that is regulating cryptocurrencies and other kinds of crypto assets. All of the discussion around the infrastructure bill passing was really the beginning of all that. And we think that this is imminent for some sorts of decisions, or at least the beginnings of bills to start coming out that really try to shape what the future of this is supposed to look like in a way that makes people feel that this is no longer a fringe industry. This is a properly regulated trading industry that everyone should have some way of taking part in a safe and regulated manner.
And in a way, what is evident that NFTs are no longer so fringe is the fact that Christie's, the aged auction house, is once again auctioning off NFTs tomorrow. That of Beeple's. Beeple made the $69 million splash at the beginning of this year. How do you think that such an auction as tonight's will help affect NFTs?
Yeah, look, NFTs are growing in their adoption. It helps that now exchanges, actually centralized exchanges, not just DeFi exchanges like FTX, like Coinbase, are jumping into the NFT space. NFTs have a lot of appeal for people outside of crypto because they make crypto relatable. Thinking about things like layer one blockchains and staking and wallets and addresses can be something that's hard to get people's minds around. But the idea of a collectible, a piece of art where you can trace the origin of the art to a particular creator or minter, that has a lot of appeal and analogy to other kinds of collectibles and communities in the world, other kinds of art communities. I think that NFTs is something that's really going to help the world get more into crypto, not less. And I think that seeing these auction houses really equate NFTs with other forms of art is only going to help that general adoption of NFTs.
FTX US President Brett Harrison, great to have some time with you. And of course, our very own Ed Ludlow, great questioning and great analysis from you two. We thank you both. Meantime, let's take a look at what Apple CEO Tim Cook has been talking about cryptocurrencies as well, looking at the features there. But there are no immediate plans for Apple to accept crypto for its products. Cook also revealed that he personally invests in cryptocurrency, but that he doesn't have any plans for Apple to invest in the asset. Coming up, behind the tech industry's boom into the stock market's hottest and most profitable sector, Mark Mahaney of Evercore ISI out with a new book on how investors can identify future winners in the space. I'll chat with him next. This is Bloomberg. Mark Mahaney of Evercore ISI has been covering internet stocks on Wall Street since 1998. Morgan Stanley, Citibank, RBC Capital Markets. He has seen the boom in the tech industry become the stock market's hottest and most profitable sector. And now he's out with a new book titled Nothing But Net. It takes a look at the underlying drivers of tech outperformance and how investors can identify future winners in the space. Mark joins us now. And Mark, I mean, brave to take on writing a book, not for the faint-hearted, not for those without as much time as you have, as well as when you're trying to work on the side. What sparked the idea? Why sign up for such a Herculean task?
Well, I do enjoy writing. I've been covering tech stocks and internet stocks for 25 years. I did want to take a stab at stepping back and thinking about big lessons. And then I was a little bit inspired by a classic book, Peter Lynch's One Up on Wall Street, written in 1980. Just great fundamental advice for retail investors, even institutional investors, about how to tap into the market. And I thought I wanted to do something similar, except using today's household names like Amazon, Netflix, Facebook, and Google. I thought I could pull together those lessons. I enjoyed the process.
And let's talk about some of the fundamental advice, because a lot of it comes down to perhaps not looking at fundamentals in the way we used to, certainly with value stocks.
Well, I think that's true. If I step back, if there's one thing I try to get across to people, one thing only, it's remember the phrase DHQ, or the acronym DHQ, dislocated high quality companies. I think the best way you can invest in the market is try to mitigate valuation risks and mitigate fundamentals risks. And you do the first by looking for stocks when they've corrected 20 or 30%. The second, though, is the more important thing, and you try to find these high-quality assets that have facing large total addressable markets, excellent management teams, super strong consumer value propositions, and companies that are really good at product innovation. If you can put that package together, those can be really good, sustainable investment longs. I guess that's another thing I'm trying to get across in this book. You don't need to trade to make really good money. With lots of caveats around there. You don't need to trade to make really good money investing in stocks if you invest rather than trade. Yeah,
but sort of buy and hold. And many didn't when it came to the likes of Apple and Amazon. If I could sort of be paid $1 for every story of someone who says that they sold out at the wrong time. How much perseverance, how much patience did investors need to ride out the promise of no jam today, but jam tomorrow? We're investing for the business, but longer term, you'll get your profit.
You needed to have that. One of the things, I'm going to cut this both ways, Caroline. I look for management teams that are truly relentless. I love to see founder-led companies. They don't always succeed, of course. But if you look at the history of tech stocks, the biggest winners have almost always been founder-led, founder-run, obviously, but founder-led for multiple years. The biggest tech market cap names in the world have had founders involved for 2 decades. You get that kind of consistency. In investment parlance, there's this saying that past performance is no indicator of future performance. Mm-hmm. That's true. But when it comes to management teams, and especially product innovation, which is so critical in tech, actually, I think that good, successful product innovation is usually a harbinger of an ability of a company, of a management team to do more than that. So you stick with that stock, that company through the ups and the downs of the markets and through company mishits, because I haven't seen really even the most successful companies avoid mishits from time to time.
Talk about some of the funny moments within the book, some of the particular anecdotes or experiences that you really had to share.
Well, I'll tell you about one of my worst stock calls. Wasn't funny for me at the time, but I had to sell on Google at the time of its IPO, brought on TV right after their first earnings when the stock was gapping up, and I was referred to as having a 3-egg omelet on my face from one of the wiser tech columnists, strategists on the street, and he was right. But it was a great learning moment for me to step back and think about, well, where's the real product innovation going on in the sector? Leave aside valuation. Valuation is super important, but to me, it's almost the last thing you should do. You should really check off the boxes, find a high quality asset, and then think about valuation. One of the mistakes I made early on was focusing on valuation first. Find a really good asset and then think about entry prices rather than go the other way.
Well, then bring it to the here and now, Mark, because it's very hard not to look at valuation first and foremost when we've had the run up in stocks that we have. And when you see the darlings of today, the Teslas suddenly take a nosedive to the tune of 11%, they all have their idiosyncratic reasonings around that. But what now of valuations? Is it now the good time to still be looking at growth names?
I think so, but you can always find dislocated stocks. So that was one of my lessons in the book. Even the best, highest quality assets get dislocated. We'll trade off 10, 20, 30% from time to time. Sometimes because of company missteps, but sometimes just because the market rolls over. It happens. Even the mighty Amazon has had a 30% roll off. And when you see that in the highest quality assets, that's when you should buy or add to positions. So I look at companies today, the highest quality internet companies that I look at, which would I say are most dislocated today? 3 ideas come to mind. First is Amazon. It hasn't dramatically corrected, but the stock's flatlined for about 18 months now. I think that, and the future cash potential has grown. I think that's a great stock to buy if you're willing to look out 12 months or more. Second is Facebook, highly controversial. I think great business model, wonderful value proposition. That's the second one. And third, controversial, is Uber. Yeah. But I think that's it's the least proven of these. It's still relatively new, but the total addressable markets are massive here, and it's one of the leaders in that market. Lots of great value proposition to consumers, drivers, merchants, etc.
Mark Mahaney, always great to have your take and reflections as well in your new book, Nothing But Net. Go check it out, and thank you for joining us. Meanwhile, coming up, Robinhood struggles continue. The company revealed its biggest data breach in history, the valuable data that was stolen, and what that means for the company's safety-first mantra. That's next. This is Bloomberg. Let's talk about Hertz, the car rental company, ending the day down more than 19% on its first day of trading after raising $1.3 billion in an IPO. Now, the debut, coming back to the market, striking a turnaround for the Florida-based company, become a darling of meme stock traders, of course, after it filed for bankruptcy last year. Bloomberg's Eric Schatzker spoke with Mark Fields, interim CEO, and Greg O'Hara, the company's chairman, about the IPO and plans to add Teslas to the fleet.
We know our corporate travelers want electric vehicles to go visit their clients and do business in. We know our leisure travelers want electric vehicles. It's a great way for them to try electric vehicle without committing. And specifically, they want Teslas. They like Teslas, and they'd like to rent Teslas. So in combination with understanding the demand is there and an opportunity to get a very hot product, an amazing product, that allows us to put it in the hands of people who want it, was an easy decision for us.
Tom, at the IPO price of $29 a share, you've pretty much tripled your money in the space of 4 months, which in and of itself is remarkable. As you know, there are some skeptics out there, haters, you might call them haters. They don't believe in your story. They say Hertz doesn't have a firm order for Teslas. They say Elon Musk is dumping Model 3s. What can you say right here, right now, to address some of that, let's call it, confusion?
Well, I think that there's no question that there's an incredible amount of demand for our products generally. We have a very robust environment for the rental car industry. We expect that to continue. We're very focused on bringing products into our fleet, as Greg mentioned, that we know people want to rent. There's no question they want to rent Teslas. There's no question that they want to rent, higher value vehicles from all the OEMs. There's no question it's a big move afoot to electrification. So, for the people who doubt what we're doing, we would simply ask that they stay tuned and watch what we have to come, because we think that this is just the beginning of an effort to put Hertz at the center of mobility in a way to serve our OEM partners and to serve our customers, to provide a better rental experience and a better corporate partnership with those parties.
Mark, these other guys here, Tom and Greg, they're financial guys, right? You're a real economy
really
CEO. You ran Ford. You know all about operations and execution. What are the biggest challenges Hertz has to overcome in this move to electrification and the transition to what we might call shared mobility?
Yeah, well, first off, I don't look at them as challenges. I look at them as huge opportunities because we're really staking ourselves out, I think, a very important place in, as Tom mentioned, this mobility ecosystem, wherever Mobility 2.0 goes. Obviously, clearly, as we look to lead in electrification, making sure we get our charging infrastructure in place, that's happening as we speak, and then be able to, that first mover advantage of learning how to manage these large electrified fleets, I think is going to give us a very big competitive advantage, not only in the near term, as Tom and Greg said, to get customers into these vehicles that they want to drive, but more importantly, in business, you have to start looking around the corner. So as you think about autonomy down the road, those large electrified fleets, I think we're going to be well positioned to work with a lot of different partners to make that happen.
Bloomberg's Eric Shaska with the Hertz executives there. Now, 7 million customers of Robinhood were hacked, the largest in the company's history. Even some personal data like names, birth dates, zip codes exposed. Robinhood isn't giving exact details on how the hack happened, but in a bit of irony, it was a customer support staffer who helped the hacker gain access during a phone call. Joining me now, Bloomberg's Sonali Basak. And it was actually us on air that broke this. You did expertly yesterday when it all occurred. And what now? What do we learn?
It's amazing because 7 million accounts for about a third of Robinhood's users. So the scale of this hack is enormous. So the 310 customers we're most worried about, they have names, zip codes, and personal details exposed. And those are the most vulnerable group here because once those details are exposed, that could lead them to other issues down the road because those are things that verify other aspects of their online behavior. But many of these users, a lot less is exposed. So could it have been worse? Yes. However, it also happened for vulnerable areas for Robinhood, which has been investing in customer safety. This happened, as you said, through a customer representative.
Ironic, because people complain they never had one.
Exactly. Interestingly, also, Charlie Wells of Bloomberg has been talking to a lot of users who have been very nonchalant about this issue. They say it's part of the course of doing business online. But with that said, should there be more financial losses for these customers, which have not happened, as we know to this point, then that would pose a much bigger risk for Robinhood.
Particularly when it comes to crypto, people are always worried about, certain parts of their cryptocurrencies being exposed and being hacked in other parts.
Exactly. So cryptocurrencies is one part of this. But again, remember, personal information. How much information do they really get? If they had gotten Social Security, bank account, or debit card numbers, which they had not gotten, as we know to this point, it could have been worse. We also know Robinhood, importantly, has hired Mandiant to be investigating this a little more. We don't have all the details on how this breach happened, as we know through a phone call to a customer service representative. Definitely not something you want to see happen to other brokerages, though, as we know, all of them are vulnerable.
And interesting that actually the shares are only off about 1% in the last 3 days.
Shows you the nonchalantness, right? Yeah. I mean, if you're a user here, you have been hacked somewhere before, but at the same time, again, 7 million customers is no small number.
It isn't. Sonali Basak, we thank you so much for all of that. Coming up, we're going to be starting to look at the end, dare we say it, of the pandemic. What happens to all those COVID testing sites? One company thinks it has the answer. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in New York. Now let's get back to the financial markets. It's a tweet and 2 days of big drops. $200 billion of market capitalization lost, hundreds of stories in the media, and it's only Tuesday. Bloomberg said Ludlow has the breakdown on Tesla.
We might not have the answers why, but I think it's important to take stock of what's happened quite literally. You can see we're down almost 17%, in fact, from Thursday of last week when Tesla hit a record high of $1,229.91. And there's a lot going on, right? Elon Musk saying or asking Twitter, should I sell 10% of my stake? You then have Michael Berry of The Big Short fame tweeting that Elon Musk wants to sell his stock because he's under pressure to meet his debt obligations. A lot to unpack. Come with me into my Bloomberg terminal and look at this chart, because Michael Berry at least got me thinking about short interest. Short interest has kind of touched up a little recently. It's 3.5% of the Tesla's float. And you can see that chart, the yellow line being Tesla's share price. Yes, okay, short interest is not there anymore. And the shorts have not been successful historically when it comes to that stock. So can we rule that out? as an option for what's happening with Tesla stock? Hard to say. Come back to me in the studio and let's bring up a tweet from Elon Musk, the tweet from over the weekend about whether or not he should sell 10% of his stake. You have some Wall Street analysts saying on Tuesday, it at least gives investors an excuse to sell. They may still believe in the long-term thesis when it comes to Tesla, but there's been this series of negative news, and a lot of people have ridden this stock right to that fresh record high, made a lot of returns in the process. So that seems to be the thinking on Tuesday. We don't know yet if Elon Musk has started selling, but what we do know now is that with a tweet, you get an excuse. A lot to unpack, Caroline.
How we love CEOs that tweet and the impact that it can have. Ed Ludlow, we thank you so much. Always so smart. Meanwhile, the end, potentially, of a global pandemic could be near.
We're on a downward trend. We want to keep going on a downward trend. We're not going to be having to wear masks forever.
Here's hoping, at least. Of course, that was Dr. Anthony Fauci, the director of the National Institute of Allergy and Infectious Diseases, speaking earlier on Bloomberg about, well, COVID cases starting to plateau. And while we're not out of the woods yet, let's not say that, but we are starting to look at the future, at least. And that's exactly where my next guest is currently focusing. He's the CEO of Color Health. And on Tuesday, the company announced $100 million in Series E funding as it looks to expand its more than 6,500 COVID testing sites in offices and schools. Joining me now, the CEO and co-founder, Othman Laraki. It's great to have some time with you, Othman. And first and foremost, $100 million, what are you going to do with it?
Hi, Caroline. Well, thank you for having me on today. Maybe I'll start off by just sharing a little bit about what Color actually does. So we are a company that provides essential and public healthcare services in the context of where people's lives actually happen. And so, over the last couple of years, we've been building and deploying services across the U.S. In very different settings, whether it's like schools, universities, workplaces, even community settings like churches. So now we're running almost like 7,000 either testing or vaccine sites. And so to your question about what we're planning on doing with this fundraise, but also just generally in our operation, is that what we found is that in general, when we're thinking about health equity and access to essential healthcare services, one of the biggest factors in people being able to access basic healthcare is the immediacy of access and simplicity of access. And that's the big driver for everything that we do, which is to take these essential services and deploy them in the context of people's lives. So I'm happy to walk through a few examples of that if that's helpful.
I'm interested as you walk through those examples, because I know that you've been, offering COVID services to the likes of California, Massachusetts, the state governments, the universities. But there's also an awful lot of other places that want to become closer to all of us, give us access. I'm thinking of CVS. I'm thinking of the pharmacies on the high street. They want to be able to give me my flu shot, to be able to walk in and continue the testing that they've currently provided when they gave the vaccines. How are you going to tackle this sort of a competitive space?
Yeah, so I think it's, first of all, I think it's such a vast and challenging problem that I don't think there's going to be a single way to do it. But I think one of the things that we have seen time and time again across different industries is that when you bring immediacy, when you take things closer to people, you actually get an exponential increase in utilization of various services. And that's what happened, for example, in retail and e-commerce and other services like that. And the way we think about it is like when you think about, like, say, school children, for example. Right now we're running thousands of both testing and vaccine sites in schools. And when you think about how do you serve the school-based community, the most logical and low-friction place to do that is in schools. And so, the way we think about it is like I think there's a place for centralized healthcare, which is the traditional model we came from. But when we look around the world and, as well as other examples of other industries, the ability to take things into the context of people's lives and in their communities, we believe to be one of the biggest things we can do for public health. Absolutely.
I mean, goodness, being able to get my flu shot here and work, seismic, so easy when you've got a busy life and trying to care for my own kids myself. Othman, I'm interested in, as you look at a $4.6 billion valuation now, you're a company that knows how to pivot. You were doing, genetics testings originally, sort of like the competitor 23andMe, and you pivoted well. I'm interested in, therefore, how your relationship evolves, not only with companies, with governments, but also the insurers. Are you going to be working in lockstep with them? Because what's so interesting about COVID is almost we didn't have to worry about the insurer. It was the federal government that wanted to put these things in our arms.
Yeah, it's a great question. I think one of the effects of the COVID crisis, obviously it's been an incredibly challenging window of time for all of humanity. But I think in these times of crisis, what tends to happen as well is that it creates a mobilization that moves people out of a local maximum. And the thing that we've seen is that all of the key stakeholders in healthcare and in public health have dramatically changed their approach. Like we're seeing that with innovative departments of public health, like in California, Massachusetts, a number of other states. Some of the largest manufacturers of healthcare kind of services and supplies, like Thermo Fisher, PerkinElmer, and so on, have all taken a very big step up to drive access and immediacy of these services. And so I think the other big thing that's really changed is our own expectations. Like through the last couple of years, we've all seen that it is possible for us to receive basic services in a way that's way more convenient as part of our lives. And I think that expectation is not going to change. It's not going to go back. And I think that is one of the biggest shifts I think that's happened in the entire industry, at least for the last 20 years. And so I think this is going to be a big shift that when we look back, I think a decade from now, we're going to see as one of the big threshold moments for how we think about public and population health.
And often you were mentioning how you've looked at other countries and seen how perhaps they more efficiently do things than versus the US. Are you looking at international expansion yourself as well?
So we have, in fact, actually, pre-COVID, we were doing a fair amount of non-US work, but through the COVID crisis, there has been such a huge need locally that has been the biggest kind of driver of our own focus, just to be able to serve our community and the kind of the country where all of us at Color are mostly living. But frankly, like the same pattern of using technology to distribute basic building blocks of healthcare, I think is actually something that is going to apply in a number of other countries, slightly differently because the way the finances work will be different through a single payer system versus not. But the essence of the distribution through a technology first and high leverage model, I think is something that's actually going to apply quite globally, so not just in the US.
Color Health CEO Othman Naraki, thank you so much for joining us and sharing in your news. Congratulations on the fundraise. Meanwhile, well, it's one of the most storied companies in US history, General Electric. On Tuesday, the company's chairman and CEO, Larry Culp, took the big but long overdue step, perhaps to many, to break up the company into 3 publicly traded companies. Culp told Bloomberg earlier about why he made the move now.
I think the board and the leadership team are firmly of the view that on 3 distinct bottoms, these businesses will be more focused, there'll be a higher, greater level of accountability. We should have sharper capital allocation, more strategic flexibility. And frankly, I think it's going to be good for the team as well, right? The team that we have today, certainly the team that we'll build over time. We all know that today's talent markets are more mission and purpose driven. We'll stand up 2 new boards full of strong directors with domain expertise. And I think we'll end up with investor bases focused on these pure plays, investors that are probably underinvested in GE today. You put all that together, it's clear this is the best path for us to unlock and create value going forward.
Larry, I suspect you've learned from bitter experience. I have, that there's no such thing as a free lunch. You have to pay something to get anything. And obviously there are some benefits that we'll go through that you think you'll see. But are you giving up something in the so-called S word, synergy? Because it was thought that General Electric did have some benefits. For example, in some of their research work, that maybe research you did on new hydrogen-powered turbines would help you in aviation. Are you going to give up some of that?
David, the GE team's heard from me for the last 3 years that I will bet on the benefits of focus every day, far more than the often illusory benefits that come from synergies. Now, we certainly enjoy those synergies today in certain places, but more and more we've been running the company on a decentralized basis, not as one GE, not as even the 4 reporting segments, but the 30 P&Ls that deal with customers that compete in the markets every single day. So if there are synergies that we enjoy today, we'll work to continue those, of course, but the vast majority of the benefits here will come from focus.
So that's why you're doing it. Why are you doing it now? What about the timing now? Why not a year ago, 2 years ago, or a year from now, or 2 years from now?
Well, we've had a lot of work to do to take care of the balance sheet. We've reduced our debt load by over $75 billion over the last 3 years. We also needed to strengthen our core operations. And if you look at what we'll do this year in terms of our adjusted free cash flow, should come in around $5 billion. I think those 2 proof points needed to be in hand before we could even entertain a question like this. It certainly helps being on the other side, or increasingly on the other side of the pandemic. But also our customers want GE at its best, focused on them, whether it be our utility customers coming out of COP26 dealing with the energy transition, our airframers and our airline customers dealing with the post-COVID recovery in that space, let alone everything that's happening in precision healthcare.
What's going to happen to the General Electric name? What's going to happen to the logo? I mean, we all know it's been there forever. Who's going to get that?
Well, I think everybody wants to make sure they hang on to their part of the brand, right? The monogram was recently evaluated at nearly $20 billion of brand value. It means a tremendous amount in each one of these markets. So we don't have a definitive brand plan today. We'll work through that as we will work through other questions in the months to come. But rest assured, every business will share the GE heritage.
So one way to put it, what you're doing is unscrambling the omelet. So you've got an awful lot of things to work out over the next 2 or 3 years, no question about it. But one thing that has been a significant factor for you and for General before you were there is this legacy sort of healthcare long-term contracts. Where are those going to go?
Those, our long-term care insurance business will stay with the core corporate entity, which will be, in effect, GE Aviation. So as we go forward, GE, as you know it today, at a corporate level, will spin healthcare, will spin power and renewables, will retain aviation, as well as our long-term care insurance operation, in addition to some other liabilities.
GE CEO and Chair Larry Culp speaking with my colleague David Weston a little earlier. Meanwhile, coming up, more earnings. We'll talk to Blue Apron's president and CEO, that's Laura Finley, about their third quarter results and what's next for the meal kit provider as we come, hopefully, slowly out the other side of the pandemic. And as we head to break, let's take a look at Poshmark. Shares of the online fashion marketplace slumping after hours after fourth quarter revenue and adjusted EBITDA forecast. They missed estimates. We'll keep an eye on this story. This is Bloomberg. Let's talk about the shares of the meal kit provider Blue Apron. Clawing back Tuesday after, well, dropping 14% in pre-market trading. This after the company missed third quarter estimates and posted, well, perhaps a bigger loss compared to a year previously. What's their outlook moving forward? And how is the company managing with, well, what we hope is a post-pandemic world? Of course, amid some of the supply chain issues we all face. Let's ask Blue Apron's president and CEO, Linda Finley, who joins us now. And thank you so much, Linda, for spending some time with us. Let's talk first and foremost about, well, the future as we look at a loss that continues. Do you hope to gain profitability? How do you see, the world evolving in meal kits? And indeed, now you're branching into deliveries now of fully made processed food.
So we see this as a pretty standard impact of seasonality with a little bit of a twist this time. So Q3 in the meal kit industry tends to be the highest cost quarter no matter what, because of the fact that we're very concerned about food safety and it's the summer months. So we tend to use extra packaging, extra ice, et cetera. So Q3 is historically usually our lowest revenue quarter and highest cost quarter, and that's pretty consistent in the industry based on seasonality. What we saw this year was actually a very interesting spike in pent-up travel demand that actually came into the business just from people who were trying to get travel in before school started. Maybe they hadn't been able to travel earlier because of COVID. The interesting aspect about this quarter is we demonstrated what we had intended to, which is we've been really focused the last 2 years on building value per customer. And so our revenue per customer, AOV, and orders per customer remain extremely high in post-pandemic trends, even with the high travel that we actually saw this quarter. So we look at that as a very positive sign ongoing for the business when we think about the ability to drive customer growth on top of that and then push towards profitability. But at this point, with the $78 million that we just raised and closed this past Thursday into the business, we're really going to lean into marketing to scale on top of that and focus on growth for the next year to really drive that customer acquisition number up on top of those key customer metrics that have been so strong.
And you're also changing what you can offer to the customer at the moment. You have still, well, the ingredients being delivered, the menu options, but you now have Heat and Eat, which is sort of your foray into prepared single-serving meals. How is that going, and who are you really targeting in that?
It's really about flexibility. So the thing is, we want to provide very high quality meals to our customers and make sure we're meeting their needs where they are. So the core meal kit is still very successful for us. We have the highest quality ingredients, very high animal welfare standards, and great recipes. Now we've also introduced, you can buy single boxes on our market where you can actually just buy a pre-configured box without a subscription. And then we layered Heat and Eat on recently as well to give people different options to be able to add more food, more meal occasions. With Heat and Eat specifically, what our customers were looking for were the ability to supplement their core meal boxes with prepared meals for lunches or for on the go, you know, when the kids are going to soccer practice or something and you need something really quick, but they wanted the Blue Apron quality. So this is becoming very additive to the business as we expand, and then we continue to introduce new products that'll actually open up new audiences to us as well.
It's interesting that you're talking about, you know, how costly ice can be in the summer and how that is a difficult element. All I can think of is supply chain issues at the moment, the cost of food in particular going up. How is that affecting your business?
We've definitely seen cost pressures when it comes to food, when it comes to logistics, and we try to manage that very carefully. On the food side, what's interesting about Blue Apron is we are a direct supply model. So 70% of what we put in the box comes directly from the producer, and we have great relationships with those suppliers in order to maintain quality at a reasonable price. And so we're very focused on continuing to manage those costs without sacrificing anything about the experience in the box. And we did see a lot of those cost impacts come into Q3, which is expected. We also saw a lot of the logistics costs come into Q3 as well. But what we think we've seen at this point, based on our discussions and negotiations with our suppliers, is that most of that impact is already visible. So in other words, what you're seeing in Q3 as far as impact, again, that's always our highest cost quarter anyway, is really something that we can predict and manage going forward. And we expect margin to actually recover coming into Q4 and then, of course, into 2022.
Thank you for being so transparent with us. Thank you for coming on, telling us about the new products. Blue Apron President, CEO, Linda Finley. Great to have some time with her. Meanwhile, coming up, online insurance company Lemonade sets its sights on autos. We'll speak with the CEO, Daniel Schreiber, about their expansion plans and their latest earnings. This is Bloomberg. Insurance technology company Lemonade rolling into the car insurance business, and in the process it's acquiring competitor Metromile, a data science company focused on auto insurance. But Lemonade stock actually was down, as you see, 11.8%, one of the biggest falls since March following the announcement, even as the company recently posted strong third quarter results, beating estimates and boosting its revenue forecast for the full year. Let's dive into all of it with the CEO, Daniel Schreiber. And Daniel, what do you make of investors' reaction to the purchase?
Honestly, not that much. We tend to try and shy away from the gyrations of any particular day. As you said, today we announced stellar results, I think, for the quarter. We surprised, I think, by exceeding a lot of market expectations, 101% growth in revenue. So feeling good about the fundamentals, trying to manage the business rather than the stock. And then having launched car insurance just last week and overnight last night announcing the acquisition of Metromile, we feel the wind's in our sail and a lot of opportunity ahead of us.
Are you worried, though, that perhaps investors are sort of stating a kind of a concern here in terms of the price being paid or how you're going to be adding to the symbiosis of the two businesses? What do you think you need to prove to them?
So actually, almost all of the analysts who cover us brought out very positive coverage. So the market reaction in terms of the stock price is not reflecting what we're hearing from the institutional investor base or from the retail investor base. So we do see this oftentimes. Acquisitions get rewarded, so to speak, with negative returns on the first day as investors digest the news and update their models. I'm actually incredibly optimistic. There's I think tremendous synergies in the deal that we've just announced. We're acquiring a company that has over 115 million or roughly $115 million of in-force premium, and we're paying an enterprise value of just $200 million. They have $215 million in the bank, and they've got 10 years of experience in using data science for car insurance, having monitored billions of miles and let their AI algorithms crunch those. They're really one of a kind and have capabilities that are unavailable to our competitors, and I think put us in a very strong position as we enter this new market space.
I can see that it helps certainly with your offerings and being able to offer many types of insurance across one particular person. So I could get my renter's insurance, or they can get my pet insurance, they get my car insurance with you. How will it add to profitability, Daniel?
So you're absolutely right. We IPO'd 16 months ago just as homeowners, and we've since added pet and life and now car. So we're certainly moving at a fast clip. Our profitability in the long run, I think, will benefit tremendously from this. We're entering such a huge market, ostensibly an almost unlimited market from where we're standing. You're talking about something like $300 billion in the US alone. So for us, this creates tremendous headroom, not that we were particularly cramped to start with. But it really does help with the unit economics, because the bundling and the cross-selling are where the great unlock of value and profitability come from. So as we launched pet insurance, for example, we suddenly saw 30% of our sales coming at zero customer acquisition cost, because existing customers were buying pet insurance and increasing their premiums 3 or 4-fold, so hundreds of % increase. And we've seen the same as we launched life, and car really is the biggest unlock of all. In a sense, we've been operating with one hand tied behind our back. You try selling homeowners insurance, which is the bulk of our business, without the ability to bundle car insurance, and you're at a distinct disadvantage. So being able to add these capabilities, I think, unlocks tremendous value for our existing business. And when you look at our 1.4 million customers, they are spending today over $1 billion on car insurance. They've just not had the opportunity to spend it with us. I think from all perspectives, it's got to be good news.
Daniel Schreiber, great to have some time with you, talking through the business model and indeed showing off your beautiful artwork behind Paint Dip Flowers. Lemonade CEO, we thank you. That does it for this edition of Bloomberg Technology. Make sure you tune in tomorrow. DoorDash CEO is joining. This is Bloomberg.